Hey Dane, wanted to jump on here real quick. This is Mike. You've met him, but we wanted to put together a real quick example for your buddy who is buying all of his equipment in cash. Remember you saying you just bought a big dump truck, and Mike has this calculator right here. It allows us to compare apples to apples, basically show him, what he's doing now as opposed to how we can provide value.
Yeah.
So with that, I'll let Mike run through it for you guys.
Awesome, JT and Dane. Thanks, man, for this opportunity. JT kind of gave me the basics understanding of your friend and how he's running his business. And as you know, we work with a ton of small to medium to large size business owners. And like your friend, many of the clients that we work with believe that like kind of cash is king. They get to control cash. They don't want to have a ton of leverage. They don't want to loan out and borrow and put a lot of risk on their books. So they use cash when they go to buy equipment. So what we try to explain to clients in using this tool, and it helps us kind of visualize it for the client is, hey, there's whether you borrow money from a bank and ask for permission and pay them a rate of interest, that's really easy to see, how much lost interest is going out the door. But when we spend cash, there's a cost in most cases. So this calculator helps us show that and then provide a third alternative. And so that's what we're going to look at today. So um, here's what we're looking at. A lot of numbers on the screen. I just want to kind of lay out the picture. So this is it, let's call it an operating account, maybe even a money market at a bank that where the bank lets you earn some rate of return. Right now, we're not showing any rate, right? We're showing $220,000 a year going into this business account and then 84,000 a year for 5 more years. Total of $1.52 million going into just a safe, just cash. Well, we're not going to put it in a safe. We're going to put it into a bank and use that. So we're looking at a 35-year snapshot. So I'm not sure how old this client is, but most of our, let's say he's in his mid 40s or early 40s, and we're looking at 35 years. Not saying he's going to be in business for 35 years, but he's going to operate for the next 10, 20 years and then maybe sell the business, but still have a need for cash, right? We're looking, hopefully he's on this earth for 35 years, right? So we're looking at a long-term scenario here because this is not a short-term strategy. This is a long-term play, but we're just talking about a savings vehicle, an operating account, something where he can generate more money with his money. And so let's put an earnings rate on this bucket of money. We look at a 30-year average in savings accounts, money market accounts. It's about 1%. It's actually a little bit less than 1%. So I'm going to try and provide the benefit of the doubt here and say over the next 35 years, this operating account is going to earn 1.5 every single year, compounding. So that's 1.5 million going in, and that's 2.4 million at the end of that 35-year period. I could scroll down every time, but just know that it's keeping track for us right down here at the bottom. Well, the downside of those type of low interest bearing accounts at the banks, at commercial banks, are the IRS doesn't like those. So if we earn $3,300 in a year in that account, the IRS says, okay, that money goes at the top of your income bracket and it's going to be taxed at an exorbitant amount. So right now, I just put it at 35%. Who knows where taxes are going to fall over the next 35 years, but just keeping on average the highest tax, roughly the highest tax bracket, 35%. So now you've put money into an account, you've earned on that account, and you've paid taxes in that account. So that's our baseline. And we're going to just call it a money market or operating account, and that is $2.06 million. So I'm going to try and keep track here. So as you can see, we're not going to just put money in that type of account. Let's say, for instance, this client, this gentleman that Dane, wants to buy those dump trucks. And I think the number you said was around 250, 270, something like that. So let's say he buys a dump truck every 4 years, over the next 10 years. So we're buying 3 dump trucks, $270,000 of cash coming out of this account. And that's a total of $810,000. So at the end of that 35 years, after buying 3 dump trucks, he's got 982K. So that's what's that? 1.2, roughly 1.1, little over $1 million. So The point there is he spent $810,000, but it cost him a little bit over $1 million of the potential growth on his account. So not only is he spending money to go buy that dump truck, the money that was in that account that he removed had an earnings potential, not just a 1 year potential, but the rest of his life. We gave up the ability to earn on that money. So there's lost interest on the growth. It's the opportunity cost of spending cash. And that doesn't show up on your statement at Fifth Third Bank. That's just money that's gone that will never recover. So I doubt, that this business owner is operating this way. More than likely, he's doing what most of my business owners do. You buy that dump truck because it's going to bring in more revenue. And over time, when that revenue comes in, he's going to refill his account. So what we're going to do now is just show money going out, and then at his control. Now, this is nice and streamlined and it looks real pretty, but most of the time, as money comes in, it just flows back into an account in all kind of methods. But I can't make the calculator look all wonky. So I just put it in, going back in over a 4 year period, over that 12 year period of time, and putting the money back in. So 810 went out. As the dump trucks brought in revenue, it brings in more money, and we put the 810 back in. So we've at least mitigated the opportunity cost of our dollar to an extent. So this is where most business owners stop. This is what we see. Money goes in, money goes out. Money goes in, money goes out. You stay on this never-ending hamster wheel of just cash flow in the business. And they feel like everything's working fine because they don't expect their cash to work for them. They expect their business to work for them, and that's where they get their highest rate of returns. And I totally agree with them. That's where you want to invest your capital, is to grow your business. And that's great. And that's not showing up on here. This is just talking about the capital. Where do we reside our capital? Well, it resides in a bank account, the commercial accounts. That's what everybody does. And that's what I used to do. As you know, JT, I was a business owner for 14 years, and I operated this way, right, that we're looking at. Well, then I read a book called Becoming Your Own Banker, and it taught me two things. Number one, it taught me the strategy called EVA. EVA is called the economic value added of our dollars, meaning if I were to go out into the market and get a $270,000 loan, let's say that business is going to charge me 4%. The market loan rate that's available right now is around 4%. That's a pretty good rate right now, actually. But let's say that, it's just giving us 4%. Well, what I should do with my own cash then is treat it with the same respect that the bankers give it. So if the banker's going to charge me 4%, I have no problem paying him 4% for that loan. When I take cash out of my account, I should replenish it as if there were a cost. We just proved there was a cost, right? You put in 2.6 and it costs you some money over time. It costs you some lost interest by using cash. So what if we just treated our money with EVA? We added the economic value of our dollar and we replenished that cash. Now it's still cash, like we're not beholden to anybody to put it back in on somebody else's terms. We control the terms of the deal, but I'm just going to replenish it with there's a little bit of extra. So I took out 810. I paid myself back with a little bit of interest, but look what that did to my bottom line. I've got now 2.11, and I went and bought those trucks and I went and bought that equipment for my business and I improved my business, and that rate of return doesn't show up here. But now my capital account is growing by definition just because I put more money back into it and I'm earning on more dollars and I'm being a good steward to my dollar, right? So whether we do business with this gentleman or not, he needs to practice EVA in his business. Now, all we do, Dane, is we show the clients another place to park capital. We use properly structured dividend paying whole life insurance contract through mutual carriers. Big, long title, right? But we take a insurance product, we design it for cash accumulation because it gives us 5 key characteristics. It's guaranteed to earn and never lose money, so it's safe. It compounds at a competitive rate, about 4.5%. It's tax-free, it's liquid, and it's creditor protected. And then there's really a sixth advantage, and this is the big one. When we use the money, we don't interrupt the compounding. So if you have a $500,000 in an account and you needed to use 270 to go buy a dump truck, you're still earning on the 500,000. There's a lot more education that goes into it. I don't want to spend too much time today, but look at what the math does by using this strategy. One thing that we do is we borrow. Now I want to point something out. We're using the same amount of cash and we're going to pay it back to ourselves the same amount of cash flow. But when I turn this on to a loan, you're going to see the payoff structure. That's all that pops up here. The cash flow remain the same. The deposits or the withdrawals remain the same. Nothing changed in this person's life. But we're going to use loans because loans are tax-free, number one, and loans don't interrupt the compounding growth. And then we're going to load in the cash values of this particular client's policy. And this client's about 42 years old, so it works perfectly in this scenario. So now you see we didn't change anything. Same deposits, same withdrawals, same refilling of the bucket, but just by definition now using a properly structured policy, we have $3.3 million in this account. But I'm going to stop because one of those benefits I just mentioned, JT, is taxes. We get to remove the IRS from this bucket of money. So not 3.3, but actually 5.09 million. And we didn't change this person's situation at all. We just used a better bank, a bank that he owns, he controls, he earns the interest on, all the while protecting his family with the death benefit that comes with it. We just bought the smallest amount we could, but that's another benefit that you can add to that. This is really a Swiss Army knife vehicle for our clients. And that's the math behind doing what he's going to do anyway. We're just doing it in a more efficient manner. So I wanted to, hopefully that didn't take up too much of your time. Hopefully you can watch this video. If there's obviously more to learn, there's books on this, podcast on this. We can educate the client on this. Just wanted to show you the math behind the strategy today. And hopefully this made sense.
No, I think the math was awesome. The numbers don't lie. You didn't change anything that the business owner here is doing. It's just restructuring how they think about using their own cash.
Yep. Just take it. It's all about how you think, man. So hopefully we can talk to this gentleman. Dane, if you got any questions, please reach out, man. We'll talk to you some more. Take care.
Awesome. Appreciate it.